If you are looking at AI infrastructure investments, there is one company the market may still be underestimating. It is not the flashiest name, but it sits right at the intersection of AI data center optics, photonics, and compound semiconductors. That company is Coherent. Let's start with the conclusion. I still think Coherent is a buy. The reason is simple. The company has moved past its earlier downturn, growth is re-accelerating, and earnings leverage is starting to show up fast. More importantly, it has a hard-to-replicate moat in indium phosphide laser manufacturing. Behind the AI data center build-out, there is one critical piece that often gets overlooked: optical connectivity. As GPU clusters get larger, they need denser and higher bandwidth optical links between compute nodes. And Coherent is one of the key suppliers in that chain. The company is already positioned across 400 grams, 800 grams, and now 1.6T optical applications. Management has also highlighted very strong demand for 1.6T products, with book-to-bill reaching 4 times. That tells you this is not just a theme. The demand is actually showing up in orders. Coherent's biggest competitive advantage comes from its shift from 3-inch to 6-inch wafers. That may sound like a manufacturing detail, but it is actually a major strategic advantage. The 6-inch process can deliver roughly 4 times the chip output at less than half the cost of the legacy process. So what does that mean? It means the company is not just increasing capacity, it is also opening up room for lower cost and higher margins at the same time. If this ramp goes well, Coherent could have a real advantage over many of its competitors. The market expects Coherent's revenue to grow from $5.8 billion in fiscal 2025 to $10.6 billion in fiscal 2028. That alone is impressive. But what is even more interesting is that EPS could grow even faster, with a compound annual growth rate near 45%. The reason is operating leverage. On one side, the 6-inch transition should lower unit manufacturing costs. On the other side, product mix is moving toward higher ASP, higher margin 800 grams, and 1.6T transceivers. And because SG&A and R&D will not rise at the same pace as revenue, profit expansion could be even more powerful. That is why this is not just a revenue growth story. It is also an earnings acceleration story. Beyond the core AI optics story, Coherent also has several additional sources of upside. The first is silicon carbide. That business is still soft right now, but the company remains well positioned in 6 substrates with both technology and customer backing. The second is CPO and aux. If AI network architecture keeps evolving, both could become important future growth engines. CPO in particular is widely seen as a major direction for next-generation high-speed switching. The third is the new supply agreement with Apple. If that revenue starts showing up in the second half of 2026, Coherent's customer mix becomes more diversified and less dependent on hyperscalers alone. That could also help support valuation. Of course, none of this comes without cost. To expand both in and SiC capacity, the company spent $441 million in capex in fiscal 2025, so free cash flow has not fully opened up yet. But the good news is that management's direction looks clear. They are still investing in the most important capacity expansion while also working on deleveraging. Net debt has already come down, and the balance sheet is moving in a healthier direction. Of course, there are still risks. First, the company has significant exposure to hyperscaler customers, so if the AI capex cycle weakens, results could be affected. Second, competition is not light, with players like Lumentum, Marvell, and other new entrants all targeting this market. On top of that, the timing of a recovery in SiC is still unclear, and execution risk remains real. The company is trying to scale 6-inch in, 300mm SiC, and newer product lines like CPO and aux all at once. If any part of that ramp runs into trouble, market sentiment could turn quickly. Overall, Coherent looks like a very compelling AI optics investment. It is not just benefiting from the AI infrastructure build-out. It also has manufacturing advantages, strong earnings leverage, and multiple future catalysts. If execution continues, the upside story here may still have a long way to run.